Evening, everyone. On behalf of DAM Capital, we welcome you all to the Q4 FY23 conference call of Ramco System. We have with us Mr. P.R. Venkatraman Raja, Chairman of the company, Mr. Sandesh Bilagi, Chief Operating Officer, Mr. R. Ravi Kulachandran, CFO, and Ms. Gayatri, VP Finance, and Mr. Vijay Raghavan, Company Secretary. I will now hand over the call to Mr. Venkatraman Raja for his opening remarks. Thank you, and over to you, sir.
Good evening, and thank you all for joining Ramco Systems Quarter 4 Financial Year 23 earnings call. And I want to start by stating that this financial year was challenging since we started on the back of one of the lowest bookings last year. The positive this year is that we have started at a much better base since our order booking have come back to close to pre-pandemic levels. We took the time this year to reinforce our product strength and invest in our execution capabilities. In our global payroll and HRP product, MRO for aviation and defense, as well as our core ERP suite. We are pleased with our broad-based business momentum across all geographies we operate in, which has resulted in improved bookings and faster go-lives this year. During FY23, our recurring revenues improved with each passing quarter. We stayed focused on refreshing our product suite, building our leadership teams, specifically in our key markets, and winning marquee clients and strengthening our client relationships. These investments are certainly showing a good momentum in our bookings, bringing out better predictability in our business. I'm happy with the robust revenue visibility at the start of the year based on client commitments, and we will continue to invest in our core products and platforms while driving a greater agility in our delivery and operations. The promoter group continued its support to the company by way of strengthening the equity investment. This, along with confidence from external investors, helped raise 130 crores through issuance of equity shares and warrants on a preferential basis. I'd like to now hand over the call to Mr. Sandesh, our Chief Operating Officer, to walk you through the operation results and details of this quarter and the financial year.
Thanks, PRV. Good evening, and thank you for joining the Q4 FY23 earnings call. We are quite excited about the health of our business as we enter FY24. Let me highlight key positive points that we will drive revenue momentum for Ramco Systems. 1, we closed the year with strong order bookings. At $90 million for FY23, our bookings for the year grew 39% year on year, with HRP leading the pack. A robust booking of approximately 51 million in H2 of FY23 as compared to US $25.4 million in H2 of FY22. This provides us good exit momentum to support FY24 revenue growth. 2, this momentum comes on the back of $5 million plus deals signed in FY23 as compared to one we signed in FY22. In addition, we have signed 19 $1 million deals in FY23 compared to 14 in FY22. By this, our average deal size has increased to $1.26 million, which is higher than the historical average of past 7 years. 3, our revenue visibility based on client commitment is up 16% at the start of the year for 2024. This is based on our go-live schedules as on 31st of March 2023. 4, our recurring revenue stream has improved with every passing quarter during the year. We started the year with Q1 at 8.03 million and ended with 9.18 million for Q4. 5, we increased the proportion of our cloud-based revenue to 58% of overall revenue. This is up from 49% at the end of previous year. The quality of growth during FY23 is fully aligned with our strategic focus on defined business segments and geographies. New customer acquisition has been across industries in EAD, ERP, and global payroll, coupled with strong booking momentum across geographies. We have won some marquee customer logos in FY23. Here are few examples of key wins and project executions during the year. We signed strategic engagement with Etihad Airways Engineering, Philippines Airlines, General Atomic Aeronautic Systems, all this for our aviation suite. Two of leading global financial services companies from Europe and Australia awarded multi-country payroll deals to Ramco. We were also trusted by Kudu Company for food and catering business and Shearwater Health. We bagged key order from Addison and Company and Freight Specialist for ERP. We have successfully implemented several key projects, including for OpenWorks in US. During FY23, we have also been consciously investing in our product suite to address emerging client needs and business changes. Two key investments that we made during the year include new investment in SASE, which is to implement fasten the implementation and system-assisted project implementation. Key product enhancement and feature release as part of our Ramco Aviation, Aerospace and Defense, powering aviation companies and MROs in their digital transformation journey. Now, looking ahead in FY24, our focus will be to further strengthen our core, leveraging transformative technologies to drive greater superior customer experience. There will be greater emphasis on enhanced operational discipline and post-optimization, thereby enabling an improvement in our margin in FY24. In closing, I am pleased that with strong order booking and increased revenue visibility at the start of the year, Ramco system is well poised to enable our clients in their digital transformation journey while driving sustainable revenue and profitable growth. Now we are open for the question.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of B. Suresh from Financial Services. Please go ahead.
Good evening, sir. Giving this opportunity. Hello.
Yeah.
For many years you will run the company. Around 20 years.
Mr. Suresh, the audio is unclear from your line. Please check.
Hello.
Please.
Sir, audio is visible. Audio. Okay. Hello.
Mr. Suresh, please go ahead with your question.
Hello.
Mr. Suresh, please go ahead with your question.
Sir, so many years you can, this company is going to getting more orders, but how much time take to profit, sir? Profit in your company? How many years take the result?
Yeah. Look, we have stated, I think, from the perspective of next year, we are seeing for growth in the revenue, as well as we have taken some optimization measures and other related to the cost, and we are expecting in the coming year we should be operationally profitable. That is what we are targeting for. I think that is what is based on some of the order bookings which we have picked up in the current year. We do see from the unexecuted order book position, we can increase 25-30% of that we consume in the next year. So with that, we should be able to see the acceleration in our revenue, and with the cost management, better cost management, we do expect hoping for the next year to be operational profitable.
And there is any other IT products companies in India? Almost all IT products companies giving good results, except Ramco. So many years the investors waiting for around 20 years. How can you can take seriously? You can run with investors side of. Don't be misunderstanding. Please take this my question. Seriously, you can run. Next year, at least you can take serious steps. Any other CEO and new lead captain company, you can understand. I know a little bit English. Please try to understand. Hello?
Yeah, thank you. Yes, we understand. And we are also taking this very seriously. And thank you for your question. It is definitely a serious matter, and we are taking it seriously.
Don't be take mistakes, sir. You can understand your investors' feeling. That's
yes.
You are good management, good group, sir. You can only for Ramco. You are petty company for Ramco. If you lead new management, new leadership, it will take.
We understand, and of course we had some challenging times which we are coming through. And what I'm saying is we are glad that we are actually improving our order bookings and coming back to pre-pandemic levels. And with the fact that the IT market and the people attrition is also much less, the people costs are also now contained, we should be able to get back to operational profitability.
Sir, one simple suggestion, sir. Actually you go for big companies, sir. And for example, Jopo is going for a little bit small areas, small giving. That type of Ramco product is very worthable. But you can split the small products. You can go for huge market in retail. You can try to that type of policy.
Yeah, that's certainly an idea. So our products have been made for large companies. So when we to transform it to become more a SaaS, that's what we mean by SaaS products. To transform it to become a SaaS product and make it easily implementable, it's all the investments we are trying to make, because the market, we realize, is ripe for that too. And these are steps we are taking, and what you're suggesting, we take it seriously, and we will look into it.
Actually, you are good products, sir, but you can split the small things easily. You can change and a huge market in retail also, and is through vendors.
Sure. Yeah, understood.
You can try.
Definitely.
Okay. So thank you for giving the opportunity.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Rohit from iThought PMS. Please go ahead.
Hello. Am I audible, sir?
Yeah.
Sir, I just wanted to understand, so in terms of our bad debts and write-offs, can you just talk a bit about how much is more to go for us in this year, and have we sort of suggest all the write-downs that we had to take?
Yeah, I think we are providing for the provisions of $2 million per quarter, and I think we had given the guidance that in the FY24 also it will continue to the first 3 to 4 quarters, and I think that's the maximum outlay what we are expecting. I think we should be completing by the next year these provisions.
So around $8-9 million is still pending in FY24, which you will take. Is that correct?
Yeah,
that's correct.
Right. And sir, despite this, after this also, you're saying that you will be operationally profitable in FY23.
Mr. Rohit, the audio is slightly muffled from your lines. So request you, sir, to please use the handset mode.
Is it better now?
Yes, sir.
Yeah, I was asking, sir, even after this 8 million kind of number in terms of provisions, you still are confident of being operationally profitable in FY24. Is that correct?
No. What was meant was operational profit. At least the EBITDA level, we should be able to break even and do better positive cash. Yes.
That is excluding this provision.
Okay, so excluding this provision, you feel that you will be profitable.
Yes.
And sir, in terms, so you gave 5-6 reasons for your confidence for FY24. So what kind of growth are you looking at in terms of top line in FY24?
See, I would not give the forward looking, but I will answer it in a different way. The year when we starting the year with the assured execution amount, which is around 16% is higher than what we started the year at the beginning of April 22 when we started. From there to April 23, around 16% higher. I think that is what our starting position is higher. And we would last year we booked around $90 million of the order, and that is what resulted in this opening position for us. And of course, further in the current year, we are expecting our order booking position to continue like last year in booking position, and that also should drive additional growth. That is why we are saying we should be able to see some healthy revenue growth also in coming years.
And can you just give some flavor around your order booking that you have between the 3 segments, HR, aerospace, and aerospace defense and ERP?
Yes, definitely. We have given it in the fact sheet. I will anyway give that back. I think we did the booking $40 million for HRP business. Just give me.
Yeah, 40 million HRP, AAD is 30 million, and ERP is 19.5. Totaling to 90 million for the year.
Got it. Understood. Thank you. I'll come back in the queue.
This was as per our plan. I think we had also given the indication in the last year.
Right.
For FY23, we will focus on 2 verticals, that is the aviation and HRP, to quickly snooze up the market, and that is what we did during the year, and that is the result of that. Around $70 million out of this 90 is coming from these 2 verticals.
Understood. And sir, one more question. I know this write-offs are an historical issue. So, and I think I have also asked this question in some of the previous Concalls. But just to understand how, as a company, are we sort of trying to avoid a similar situation in the future? Because, I mean, these are not small numbers that we've taken in the last couple of years. So, I mean, just if you can explain a bit more as to what we are doing so that we don't get to this kind of situation going forward?
Yeah. There are typically 2-3 areas in which we have taken action. One, I think, I'll just, for the areas of the order what we are picking not into newer area, rather into very familiar territory. I think that is the utmost focus which we spoke about in the last year, which we are continuing. That is the stated objective, and we are moving very firm on that. We are picking up the order in very familiar territories in repeated verticals and the product line, and we have not digressed into investing into any newer area. Number one. Second, also geographical area, like we had to provide something for in Sudan, in which the order was picked up some very long time back, and those kind of things we are very, very careful in choosing which geography we are picking, and very safe and trusted area we are picking up the orders. So these are some disciplines which we have embarked, and also delivery excellence. We have embarked on multiple programs across company on the product line to see that delivery excellence also we are imbibing.
Got it. And sir, last question. So we raised 130 crores. The money has been infused, or the warrants will get converted at a later date?
Yeah. Just a minute. Before also, I think the third area, I think on the changes, what, I was just completing the answer.
Sure. Sorry.
The business model of deferred revenue, what we were having, we are actually moving into more recurring revenue model. That also means we are not carrying any upfront revenue. Rather, we are just going as we move forward. So that also will reduce significant amount of risk in our business, so that write-off should dramatically come down. So these are the 3 concrete actions which we have taken, and which we are confident we should not enter into this situation again. That answers your first question. And on the second, you are asking on the warrant part of it, I guess. So I think of that one, I will just ask our CFO to respond to this.
The issue size was 160 crores, and we have got 120 crores towards equity and 10 crores towards the warrant, and totally we have got 130 crores. Balance 30 crores is executable within 18 months. So this is the total amount received by us, and we have used it for the object for the issue. We have used 76.5 crores, and we are left with 58 crores end of the 31st March.
And sir, what price were these warrants issued at? Sorry, I know this has been filed, but just...
274 rupees per share.
Got it. Thank you, sir. Thank you, and all the best for the coming year.
Thank you.
Thank you. The next question is from the line of Dhruvesh Sangvi from Prospero Tree. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah. Sir, can you just explain the revenue recognition in a simple way, and how does the, let's say if there is a $1 million client that you have announced that there are 19 $1 million deals signed, typically how long does it take for entire $1 million to accrue, and from future, can we say that whatever comes as a part of revenue will always be equal to the cash flows received for that year? Is that what you said?
Yes, that is what I think we are moving towards. The spikes will not be there. I think what we are doing is we are actually going into the recurring model. So it is roughly 20% of the deal can be post go live. It will be recognized in 5 installments in each year, roughly. So I think that is the...
So $1 million is typically divided by 5, and each year $0.2 million will be the revenue for this $1 million client signed in this year. Is proportionate.
That is correct. That is correct. The recurring revenue. There might be one of the cases where still on-premise licenses will be there. those foreign few, it is coming down. They are more into aviation and ERP right now. But our HRP business, we have completely almost moved to the recurring revenue model in last couple of years. That transition we have completed. Yes.
But just to also understand that our average revenues have been in the range of 500 to 600 crores over the last 3-4 years, and if I just do a basic calculation, it is like we have lost around 300 crores in bad debts. Is this correct? Including the 64 or 65 crores that we will provide for the future. So is this broad assessment correct that 50% of 1 year's revenue became bad debt? If the answer to this is yes, and I may have missed in the previous conversation, but what has led to such a thing, and if you can explain it a little bit in 2-3 statements.
In terms of numbers, you are correct. 8 million roughly translates to 65 crores. So that way, this year 65 and last year around 60 crores. So over 3-4 years, the accumulated could be around 250 crores. So that way, the numbers are correct. And we have historical reasons for accumulating this type of. We have explained the previous costs. Couple of new products we have introduced in some territories where we could not progress well, and conservatively we are providing for those cases where we will not be able to legitimately claim from the customers.
Okay, fine. So the last part on the product side, if a novice like me have to ask you that, where are we in our product life cycle in terms of development piece? And I think you hinted that you are doing the peripheral areas where you can target the bigger customers into the SaaS model. But are we satisfied with our progress in terms of product development, especially in the HR and the aviation category?
Yes. I'll answer it in 2 ways. The one in the aviation, I think the more or less the major product development cycle required for both of these businesses are complete. However, there will be we are in product business, so we would have to continue some enhancements and other, but the large scale development required will not be there. So the modernization, little bit of more area what we have to do, we will. In HR, though the product development is not there, what we are doing is creating this model for quicker implementation and other. It is not building products. It is more of the work of packaging is currently happening across these product lines. So we don't expect very large outlay of capital expenditure in both of these domains. And if you have seen our customer list, these are Fortune 500 and Fortune 100 customers, which are in both of these business segments. So some of the most large orders what we have seen are both coming from these business segments for us. And the packaging what I spoke, I think the amount what we are spending eventually help us improve our operational profitability, because the attempt what we are making is by investing into these areas of packaging, implementation timeline we would like to crunch significantly. Like in one of the business segment, what we are attempting to do is bring down the implementation from current 6 to 7 months to 2 months time frame. So eventually it will help us realize this cash much quicker. So the investment what we are making in packaging is going to improve our operational efficiencies.
Right. So thanks a lot. And if I can ask a couple of questions more, or should I join back the queue, sir?
And go ahead again.
Yeah.
Go ahead.
Yeah. Hello. Can I?
Yeah. Yes, sir. Please go ahead.
Yeah. So, as you said that the one focus is clearly on getting the implementation cycles lower. In the similar front, can you also speak about the critical investments required for marketing or again, there we have invested enough and it's just a matter of execution and time?
Yeah. Last year, if you see, we increased our marketing and sales effort, and we did, in fact, invest in US Geo and also in the Europe, and we also have gone and increased our manpower in sales and marketing in Australia and also in Middle East. That is a continuous effort which we have continued to, and based on the business growth coming from each of the region, we will continue to do that. The most of the profit what we are planning to generate will be invested back more further into marketing and sales.
Right.
That is what we will
when we say investments in marketing, is it more towards the employee count increases towards the marketing, or what are the other areas of marketing spends or investments that we seek?
Our marketing spend, overall marketing spend, if we analyze, we don't spend more than 20% of the total marketing spend on the manpower. So what I'm talking about, the investment is into content, investment into investor relationships, events, branding, then digital marketing. These are the expenditures where investment when I'm speaking. We are very carefully monitoring the productive and non-productive investment in marketing.
Thanks a lot. Thanks a lot, sir. I'll join back the queue, and very helpful. Thank you.
Thank you. The next question is from the line of Sarath Juttur from Zen Wealth Management. Please go ahead.
Thanks for taking my question. So, am I audible, please?
Yes.
Hello? Yeah, okay. So my question is mostly regarding the quarterly order intake. Like Americas has seen a sharp downtick in order intake, like from nearly $10 million last quarter to around $1.12 million this quarter. So can you please help me understand the reason? Same with APAC as well.
Yeah. The US, the 10 to 1.1, I think that is we are seeing some slowdown in the Q4. Did we see some slowdown in US? However, there are interactions which we are seeing there. We expect it should start picking up. However, in the Asia Pacific, you see overall booking-wise, I think it is a robust booking we have seen. It is more coming from the Pacific region right now. Asia, which is to be the traditionally in the range of around $40 million, we have not reached the pre-pandemic level. But it is not as bad as in the last year. We have seen some good closures coming from Asia, and based on conversations what we are having in Asia and also pipeline build-up there, it should only improve further from here. We are not seeing that kind of decision paralysis right now in Asia Pacific region. We are having good amount of momentum here.
And even India and EMEA has seen very sharp uptick. Are they sustainable, or are there any one-offs or something like that left?
India is being there. I think it is back to the number where we were earlier, and even that should continue. And Middle East, we had one very large order coming from Etihad, so it may or may not be in that range immediately, but there are some good large deals we are pursuing in the Middle East. It depends upon how those convert and in which quarter they convert. But we have good traction in Middle East. It is, need to be seen how it progresses in the current year. But we do have good tractions there.
Okay. And also, can you please help me understand the time lag in between signing a deal and go live, business unit-wise, like across the business units? Like,
currently, in HRP business is around 6 to 7 million. That we are trying to see how to bring 6 months. That we are trying to see bring down to 2 months to 3 months. That is the attempt what we are trying to do. In case of aviation, we have both segments, very smaller end of the market where around 6 to 9 months implementation is also possible, which is we are executing 3 to 4 months. And there are also 9 to 12 months transformation deals, which takes 9 to 12 months and even sometimes higher than that. So we see that in the aviation business, and similarly into ERP business, similarly it follows like aviation. It is in the both segments.
Okay. That's it from my side. Thank you for answering my questions.
Thank you. The next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Hi. Hope I'm audible. Yeah, thanks for the opportunity. I have a couple of questions. Firstly, if I look at the license revenue for the quarter and also for the year, for the quarter it's just 0.4 million. So is it safe to assume that now all three businesses booking are happening broadly on the license basis, or is it just a coincidence for this year that we are booking most of it on the license mode? SaaS mode, sorry.
One, I think your observation is right. License revenue in the current year is lower than the previous year. There are two reasons. One of the business segments, that is the HRP, we have entirely moved to recurring based. We don't, anticipate big uptake of the on-premise deals in HRP. So licenses revenue coming from that business unit is very unlikely. Second, even in case of aviation deals, which we typically used to get licenses deal, it is moved to annuity-based licenses. That is a change which we have seen in the buying pattern. So what I'm saying is, if there is earlier we were getting $1 million deal and $1 million licenses revenue, we would have got money and recognition both immediately. But now customer requests are that it's at the beginning of every anniversary they would like to make 20% of the payment. So there also we are seeing a change in the behavior, buying behavior. And I don't know whether that is the continued pattern, because we are also having in the pipeline and we are discussing pure licenses deals also in aviation and HRP and aviation, ERP and logistics. We are still having deals with licenses revenue of upfront payment.
So are you trying to say for these three segments, let's assume if you're going for a deal which ideally you would have charged 1 million of upfront license, which is generally perpetual or a certain term based, that you are now dividing over the term. So what is the term that you are dividing that into an annual piece?
Sir, your question is on the recognition of that, because your voice is not very clear. So please let me know my understanding is correct. What you are asking is, if there is a $1 million of perpetual license, how are we treating it? Vis-a-vis, if it is annuity based, how we are treating it?
No, that understanding I have. I'm just asking one thing, which is, assuming the same customer you would have asked for.
Sorry to interrupt you, Mr. Jain. Please use the handset mode, sir.
Sure. Is it any better?
Yes, sir. Please go ahead.
Yeah, sorry for that. So I'm saying, let's assume you had a customer which you would have charged a 1 million license on a perpetual basis or a certain term basis. What is that term which you are dividing it? Because now you are asking for annual, so you must be taking a much smaller piece. So you must be dividing the license opportunity into a number of years. So what is that tenure?
We are signing usually for the 5-year term. So if you are signing the perpetual license, then it is if it is for the immediate payment perpetual license, then whole we are taking it in the 1 year. Otherwise, it is on the 5-year term. 20% each year.
Yeah. Rahul, your question is on the value?
Yes. So when you say 5 years, essentially if I was selling a perpetual license for 100 rupees, now the customer is saying I don't want to sign a perpetual license. What you would charge as an annual license, because he would continue to use it beyond 5 years also, right?
Correct. That is a continuous, even after the 5th year, they will continue to pay. It won't be perpetual. If it is an annuity, then it is a continuing one.
And to your question, we'll be charging 40 rupees in your example, Rahul, per year subscription. When we charge a perpetual license, one-time license is 100 rupees, and 5 years AMC is typically another 100 rupees. So we typically charge 40 rupees per year. That's the answer to your question.
Yes, sorry for pressing a bit more. What I'm trying to understand is that if you would have charged a 5-year license, which is your typical deal at 100 rupees, and now the customer is insisting on annual payout, so is it 20 into 5 and then another 20 will come on the 6th year? And in a normal scenario, you would have taken 100 rupee upfront, and in 6th year, you would have charged another 100 for next 5 years.
Okay. What I will say is, if it's a perpetual, typically what happens, the $100, we will charge in the year 1, and year 2 onwards, you will charge 20% of the maintenance fees. So in 5 years, 6th year, you will continue charging only 20 rupees going forward.
Sorry. I'll take this offline. This is basically a confusing between license and AMC. I'll take it offline. I'll go to the more pertinent question, which is on the HRP business, where we have witnessed a 50% growth in the booking, which is commendable. So can you help me understand what is driving this traction? Is it more led by our own initiative, or is it coming from the Workday Oracle channel that we were banking on a couple of years back?
It is all areas. What we are seeing is a good traction coming from the Workday and Oracle, where HR has gone live. Now people are looking to transform their payrolls. That is the one area we are seeing the traction is built there. Second, we are also seeing our own effort in multi-country payroll, because I think that's another thing we are seeing from the global customers for the countries where we have our payroll to bring one vendor and one platform for their all countries. That is what is driving growth. That is what was on expected lines in which we were pushing this product.
And this, how many countries we have reached now from the payroll perspective?
We have on our own platform built 60 countries, but we have also acquired capability to service our customer for over 100 countries through what we call as the ICP. So for gross to net component of that, we are building. We have built capability to actually execute gross to net and service our customer for another 40 odd countries. So overall, 105 countries we are able to support our customer if they are coming on our platform.
And because of these initiatives, have you been, especially on the Workday Oracle side, is it helping us to get into newer markets where we were traditionally not present much, like Europe, where we were building few payrolls? So is that happening, or is it still in the pipeline?
Yes. Europe also we are continuing, and I will answer it in two ways. One, we are seeing good traction in the Europe. Hitherto that was not accessible to us as a market. We are able to see that from the European countries, and on back of these deliveries as we start, we will continue to build large headcount countries payroll on our platform. So that will continue, but we are not waiting for building the payroll and going into market now. Because we are having this ICP, we have started executing, so we are approaching the market much faster. Because it took us around 8 to 9 years to build most of the statutory and gross to net for most of the Asia Pacific countries. So we want to quickly move into the other regions.
Sure. And on the AAD business, which market is driving this demand, and are we also looking at Indian market loads of action happening both on the civilian as well as defense side.
Yes. To your answer, India market definitely yes. We are looking for civilian and defense both, and we are having traction in this market. And segment of the aviation business, what is driving, heli segment, which is traditionally our this one, that is anyway we have covered most of the large players there. MRO is also growing for us. That is across all geographies. That is in the Middle East, Europe, Asia, and US. In all geographies in this segment, we are seeing growth. The defense portion of US, what we started, that is a bit slow, and which we anticipated that is going to be 12 to 18 months, and it is with the US slowdown, it is tracking a bit slower. Having said that, we are seeing the traction in the defense segment, even in other parts of the world, India, Asia, in a couple of countries, and also in Pacific region.
And in this segment, we saw last year our bookings were last year as in FY22 was very low, but FY23 it has picked up in every quarter, and the revenue as a result was weaker in FY23, but now going into FY24, you think there could be a sharp jump because of the bookings that we have, or it would be a very gradual move?
We are seeing, like the rest of the business, because of the bookings what we have done in the FY23, we are having very healthy executable number at the beginning of AD business. We are expecting very healthy growth.
Right. And yes, sorry.
Yeah, from the current revenue perspective, what we have seen, we are expecting a growth next year on this business line.
Okay, and ERP here, the bookings are not very encouraging. What is the roadmap here in terms of when we expect to recover? How much more investment need to happen here?
Last year, if you recollect, beginning of the call, I said that was a deliberate effort. We allocated our marketing spend and sales fund in the FY23 into two business segments. That is the aviation and HRP, and that is why it resulted in concentrated closures. Around $70 million out of $90 million came from these two business segments. That was our deliberate effort so that we are focused in current year towards that. However, current year plan has a plan, and we have allocated funds even for the ERP business. It should be better than what we have seen in the last year in the coming FY24.
Okay. And in terms of readiness of the product, there is nothing more to be done, or it's a general thing that you would do, or some special efforts are still required to make it for the real go-to-market?
We don't need the product development. It was even developed last year also. It was more of go-to-market and market fit analysis, what we are doing, which product to which market, and which specific geo what we have to, and that we have picked up, and we don't expect huge development even in the ERP group of products for us.
Right. And next question on the EBITDA positive kind of an outlook that we have shared. If I look at the current EBITDA losses and also look at your total cost, even if I assume a 10% increase on an annual basis, although it's trending much faster historically, and even assuming that we have the adjusted EBITDA of 136 crore, adjusted to FX and provisioning. So for this to become break even, you need to add revenues of upwards of 200 or almost 200 crore. So that 200 crore would be like 40% kind of a growth that we need to do for that. So is it coming from a significant reduction in the cost, or you expect this kind of revenue growth can potentially happen?
I think I indicate that I think overall the cost optimization measures on multiple areas. I think we had some cost on the on-site because of the pandemic time. We did incur good amount of cost because the travel was restricted. So we increased that. We are optimizing, and some areas of due to productivity improvement, what we are seeing, some headcount optimizations also we are expecting. Overall, around $6 million from salary and non-salary overall cost, what we are expecting, reduction, and after that the growth perspective what you took, and that would lead us to EBITDA positive to neutral. That is what we are planning.
Okay. So this $6 million is on the annual base to annual base.
Yeah.
And in this quarter, some actions were taken. As a result, we saw some employee costs going down. Is it one-off or is it part of this rationalization?
It is same, but the overall impact, full impact of that you will see in the Q2 of the FY24. The actions are executed. The impact of that will be seen in the Q2.
Right. And just lastly, sorry, I've taken many, but on the growth side, I mean, I know your bookings are very exciting, but that has been the case in the past. The recognition has been one of the issue of translating this deal into revenue has been our challenge historically. So do you see any kind of risk on that part, or you think now on a steady state basis we should be able to add a strong growth on a sequential basis?
Interrupt you, Mr. Jain. Ladies and gentlemen, the line for the management has got disconnected. Request you all to please stay online while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently waiting. The line for the management is reconnected. Mr. Jain, request you to please repeat your last question.
Yeah. So my last question was that, of course, your bookings are very exciting, but historically also we have faced this issue where our booking growth has been very good, but we translating that into revenue has been the challenge. So you see that could also be a problem to start with into next year, or you think the sequential momentum should play out as license is already at the rock bottom, so there's no impact coming from the license revenue front, and that's why every deal win incrementally now should add to the sequential revenue growth momentum here on?
Yeah. On two fronts, I think one, the overall unexecuted order booking percentage of conversion, which used to be around traditionally 15 to 20%, we are expecting that to be in the range of 20 to 25%. We do expect it to going up how we will consume the unexecuted order book. That is on back of some concrete steps which we have taken. I think what we spoke about the packaging and delivery excellence initiatives, what we have undertaken, that should allow us to, and automation initiatives, that should help us to realize those booked orders into our revenue moving forward. And you are right, as we close the deals, I think more and more, I think it should start moving towards our recurring revenue. So our dependence on licenses over the period should start coming down. That is what we are attempting to see, that most of the revenues we push into recurring as we move forward, and then our dependence on new order on licenses will reduce in the coming years.
I mean, just as simple as that. If the current license is just 0.4, that's the maximum impact we can take now. So sequentially, every quarter we should see growth because you already have orders in the bag.
Correct.
Okay, that's it from my side. Thank you so much.
Thanks.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Everyone, thank you very much for attending this call, and I think also we would like to express our gratitude for being patient with us, and we have been transparent in saying the transformation what we are undertaking, and me and my team are fully working towards realizing whatever we have committed to the investor community, and we'll continue to strive on that and work towards next year bringing it to the EBITDA profitability and then further growth in subsequent years. Thank you very much for joining the call.
Thank you. Ladies and gentlemen, on behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.